In periods of increased volatility, financial advisors look for tools to manage downside risk, which include option-based strategies. S&P Dow Jones Indices have recently partnered with Cboe to construct a family of options indices called the Cboe S&P Target Outcome Indices, one of the most prolific of which is the Cboe S&P 500 Buffer Protect Index Series. Hello, I'm Shaun Wurzbach, and I lead our financial advisor channel at S&P Dow Jones. And here to speak about the new Cboe S&P 500 Buffer Protect Index is Vinit Shrivastava, Global Head of Strategy and Volatility at S&P Dow Jones, and Karan Sood, he's CEO of Cboe Vest. Well, welcome back, gentlemen.
Thank you, Shaun.
Thanks, Shaun.
Well, this is a pretty complex topic in some ways, but in some ways I think it's also simple in that advisors are looking for risk-managed solutions. And Vinit and I have talked about this many times in the past. If an advisor were to look at an index that's trying to provide risk management, what are some of the things that you think that they should be considering?
Sure. I think risk management is a very topical conversation these days.
Sure.
It all started after 2008, and now we've seen the more recent drawdowns in the market. And when you look at risk management strategies, you will find that you can put them into two broad buckets. One is what we've all learned in portfolio management and portfolio theory is the only free lunch available is diversification. Mm-hmm. So you get that by creating a diversified portfolio, mix of bonds and equities, and you use that, or commodities in different asset classes. Whether it's risk parity, whether it's a straight 60-40, that's what you get from the diversification bucket. The second bucket is something we've seen quite a bit of innovation in, and we'll talk about today, is these target outcome strategies, where you use options and option overriding to essentially achieve a certain outcome, and that outcome is linked to managing the risk within your portfolio.
So Vinit, now we're talking about the Buffer Protect Index, so we're talking about options. And I would assume that you're going to tell me that S&P and Cboe have built the optionality into the index. So the advisor is not having to worry about how many options, what type of options, and the timing of these options. Is that the case?
Correct, yes. So systematic option-based strategies have existed in indices before, like covered calls. But what's unique here is the fact that there is transparency on pricing on some of these options every day. And these are not traded options, these are flex options that Cboe innovated and has pricing around. So the way these indices work is that you have, let's take one index example within the series of indices. So you have an index that actually incorporates a portfolio of options, and that's how you deliver the target outcome.
Okay.
So with the 10% buffer protect, you will have the outcome that's delivered over a period of 12 months.
So these option maturities could be laddered. That could be the construction that an advisor would expect to see.
Correct. So that's also we have individual indices that deliver, that have the specific caps that are set at the beginning of the period. And then there is a composite index that essentially rolls the 12 indices for each month into one composite index.
Okay.
And that's how that sort of laddering is delivered. So the advisor doesn't have to worry about essentially, the vintages that they need to pick. And it also addresses one of the issues of when people hit a cap early on. So it essentially diversifies across that 12 index.
So you're solving a lot of problems with this construction.
Correct. And I think it's a very unique and innovative design, and I think S&P as well as Cboe have taken a pretty big step in delivering something that the market would really find useful in this space.
And Karan, I'm sure you have some views on that as well. At Cboe Vest, what we're seeing is you're providing a number of different kinds of wrappers where this makes it accessible for an advisor to actually look at these types of indices. So maybe from your perspective, how do these work?
Yeah, well, at Cboe Vest, which is the asset management affiliate of Cboe, we're bringing these target outcome strategies to the marketplace in all kinds of wrappers, mutual funds, ETFs, managed accounts. And the idea is, as Vinit said, to bring another way to risk manage. So unlike diversification, which is a great concept, but at times can deliver some uncertainty to the portfolio, you have this contractual certainty that you get through options, which are contracts.
Right.
And the buffer protect strategy is a very good target outcome strategy, very timely strategy, which by design is going to protect the first 10%, and you're going to get upside up to a cap. And when the terms are set, the cap is set based on the potential returns that are given up, pay for the downside protection. And the investors in all forms of wrappers are more and more utilizing these kind of strategies in their risk management part of their portfolio, or hedged equity part of their portfolio, or low risk equity part of their portfolio. So it's deployed very often in the same bucket as the more diversified strategies, asset allocation strategies.
So I want to come back to you, and actually I want to be really pointed about this, because my team is working with different kinds of advisors all the time. So wirehouse advisors, RIAs, or other independents. And particularly in the wirehouse space, they may be very familiar with this kind of a buffered approach, or different kind of broker-dealer based advisors may have been very used to annuities. But you have certain class of advisors where they may have wanted that protection, but they felt like the way that it was structured in the past, it didn't meet their fiduciary responsibilities. So in terms of you looking at this from an index structuring standpoint, how are you trying to address that to make this kind of an index appealing to every kind of advisor?
Right. So, when you look at advisors and the desire to manage risk within the portfolio, target outcome strategies have a place in those portfolios, right? They have provided that risk mitigation. They have provided, whether you call it bond-like payouts, you're getting a piece of the market, and you're getting a defined outcome in the sense that you have protection in your portfolio. So these have a place in the traditional advisor portfolio. The issue had always been costs or transparency. And with index-based strategies, costs have always been the driver of why people have adopted index-based strategies. So that's a given. Transparency was important. The daily pricing, as I mentioned, from Cboe's Flex platform, is what allowed us to innovate, to create this, and allow independent advisors and others to be comfortable with the fact that they can own this in their asset allocation.
Yeah. So Karan, kind of the same question, from your point of view, now you're taking the index and you're making it accessible to an advisor in a number of different ways. Was that part of your design as well, that now you have the solution that appeals to an RIA, for example?
Yeah, no, I think that's spot on. A lot of the advisors were feeling challenged to use the target outcome strategies as they've been available in their former avatars of notes or annuities, because they're really manufactured for a more transactional sort of a business.
Yeah.
And so for advisors who have a growing business, which is more fee-based and fiduciarily oriented, these strategies fit in really well, firstly because of the cost and the transparency component that Vinit talked about, but also sort of the governance, high governance structure that comes with a 40 Act fund, as an example, the liquidity that comes with a 40 Act fund, which is the daily liquidity, and the setup from a fee perspective, where it's the cost is transparent, what you're going to get on a daily basis, what you're not getting from a price transparency basis, that is very transparent. So I think it gives advisors a lot more comfort to say that if they're managing their fee-based business with an asset allocation framework, they have portfolios, they can now say this is going to sit in a certain part of their risk mitigation portfolio, and it's perpetual in nature, as opposed to the earlier products which were mature, and as a result they had to be reinvested or redesigned. So it's really meant to be a systematic allocation to a portfolio.
Yeah. So Karan, as I think about this, what I would usually see in like a structured payout is you would have something like a 3-year note. But here, in the way that you've structured these products that are tracking the indices, it's more open-ended. Can you talk about that structure and the importance of that?
Yeah, so from a design motivation perspective, it was very key for us to consider an investment strategy that was open-ended, because for fee-based advisors, that's how they manage their portfolios. They want a strategic asset allocation that can last them for 10 years,
Yeah.
and not something that matures. From an open-ended perspective, there are two key components to the open-endedness. One is just the rolling aspect of the strategy. So your 1 year buffer protect strategy matures and automatically rolls to the next 1 year with 10% protection and a new cap. The second component is that you're not allocated to a single buffer protect strategy. You have a ladder of 12 buffer protect strategies in which you're diversified. So every month, 1/12 of your strategy is going to mature and it's going to automatically roll for another 1 year. So that has the benefit that, unlike a single maturity buffer protect strategy, where if S&P rallies very strongly and you're capped out, or if S&P falls down very significantly and you're blown through your protection level and now you're exposed, in this strategy, at least once a month, you're recalibrating to where the market is. So for investors, advisors who have a more strategic perspective to such a strategy, they might want to consider the constant recalibration to the market, as opposed to a strategy where you might, as an investor, be stuck for a longer period of time. Now, if you do have a more tactical view, I think it is good to have the option to do a single maturity strategy, like a buffer protect strategy.
Right, you have different tools depending on what your point of view is or what you're trying to achieve in terms of protection for your client. Well, gentlemen, this is a very innovative idea and potentially disruptive. Thanks for sharing your ideas with us today.
Thank you, Shaun.
Indexing innovations like this require further study and education. So advisors wanting to learn more about how the Cboe S&P 500 Buffer Protect Index seeks to provide a level of protection while potentially capturing some upside performance should visit our website, and that's spdgi.com. Thanks and have a great day.